Welcome to RBC's Markets in Motion podcast, recorded December 20th, 2023. I'm Lori Calvasina, Head of U.S. Equity Strategy at RBC Capital Markets. Please listen to the end of this podcast for important disclaimers. Today in the podcast, our last of 2023, two big things you need to know. First, with just a few trading days left to go in 2023, the S&P 500 is close to a level that our valuation model has been suggesting is a reasonable one. Second, while we remain constructive on the year ahead, several charts that we track regularly are starting to suggest the rally in the S&P 500 is due for a pause. If you'd like to hear more, here's another 5 minutes. Now let's jump into the details. Starting with takeaway number 1. The S&P 500 seems poised to end the year at a level our valuation model suggests is reasonable. Though we were more constructive than many of our peers on 2023, we weren't nearly constructive enough. We started the year with a year-end S&P 500 target of 4,100, which we upped to 4,250 in May. In hindsight, there was one model we should have paid more attention to. That was our valuation model, which was consistently the most constructive tool in our toolkit all year. That model uses the relationship between trailing average PEs and inflation, GDP, and interest rates dating back to the 1960s to project where the trailing PE of the S&P 500 should be at year-end based on consensus macro forecasts. This model has recently been suggesting that the S&P 500 could end 2023 at a 21.1 times PE, or a year-end price level of close to 4,700 when used in tandem with our 223 full-year 2023 S&P 500 EPS forecast. Back in August, before year-end 2023 10-year Treasury yield forecasts had finished moving up, the model was pointing to a year-end 2023 PE of 21.8 times, or close to 4,800 on price. What this model is telling us about 2024 has been a big topic of conversation in our recent investor meetings. Currently, it's calling for a trailing PE at year-end 2024 of 23 times, or around 5,300 when used in tandem with our 2024 EPS forecast of 232. Even if 2024 gets off to a rough start, which is normal in a presidential election year, we think the year will end up being another positive one for the U.S. equity market. Moving on to takeaway number 2. Risks of a short-term pause in the S&P 500's rally have grown. While we remain constructive on the U.S. equity market in the year ahead, another topic that's been coming up in our recent investor meetings has been whether the rally in the S&P 500 is due for a pause. We think the risks of a pullback have risen for a number of reasons. These include net bulls in the AAII survey are tracking at 25.7% on the 4-week average, more than one standard deviation above its long-term average. When this indicator is between 1 and 2 standard deviations above the long-term average, the S&P 500 tends to be up 6.5% over the next 12 months. That being said, it also tends to be flat over the next 3. This echoes what we're seeing on the weekly CFTC data on asset manager positioning in S&P 500 futures, which is close to recent peaks again. NASDAQ futures positioning among asset managers is also stalling after breaking out to new post-2015 highs. And U.S. valuations are back to peak relative to Europe, at a time when many non-U.S. based investors are expressing concern about the 2024 presidential election in the U.S. We worry the uncertainty around this event could encourage profit-taking in U.S. stocks in early 2024. Inflows to U.S. equity funds may also be starting to stall. At a time when flows to equity funds focused on several major non-U.S. geographies are starting to improve or turn positive. Leadership rotation, specifically outflows from growth funds, are a big part of what's driving the weakness, reminding us that when growth lags value, U.S. equities tend to underperform non-U.S. equities. And our final data point here, in 3 of the past 4 years and 6 of the past 10 years, the S&P 500 has been down in January. Seasonal trends have mostly been working in recent months. That's all for now. To all of our regular podcast listeners, we are so grateful you're keeping us in your queue. We look forward to continuing the conversation about equity markets in the new year and wish you all a very happy holiday season.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.